And welcome everyone. Nice to see everyone's nice and prompt. Not too sure who's been waiting, but I've seen a few people been waiting there like at least 45 minutes to join. But yeah, we're gonna do some give everyone 15 minutes to join. And yeah, we'll start close to one. See everyone in a bit.
Good afternoon, everyone. Just to bring you up to speed, it's now a few minutes before one. We will start a little after, give those who are stuck in traffic a little bit of time to join. So if you've got a chance now to make yourself a cup of tea or coffee or lunch, whatever you want to do, and we'll start a few minutes after. I think we should aim for 5 past because it seems that we're still short of numbers who are still to join. So I think that will be the decision. We'll start promptly at 13:05. Thanks.
Hi, and welcome everyone from my side at least. We're still waiting for a few more people to join. I see everyone now that it is one, a lot more people are starting to join again. We're just going to give it a few more minutes just for everyone to log in and catch up. Um, Hi, Luke. Just to let you know, I see you put your hand up. We're just waiting another minute just for everyone to join because we haven't seen the majority in yet. So just to give them time, we're giving them one more minute to join, and then Stan's going to do the introduction in a second. We're looking better now. The numbers are improved greatly since this last couple of minutes.
Okay, so maybe we start with a bit of an introduction, and then the show can start it in a minute. We have Anthony Chait, George Hornsby, and Mark Kirsten joining us from Ziridium. We're going to talk about exchange control, where we're going, Quo Vadis, for those of you who don't know Latin. And so it looks like an interesting afternoon. I want to thank everyone for joining us today, and also to Anthony, George, and Mark for joining us and spending time with us. And I'm going to just drag out another few seconds, and then if you don't mind starting, it's now 13:05. Anthony, George, and Mark, the floor is yours.
Thank you, Stan, and good afternoon, everyone, whether you're watching live or perhaps by a recording. This is Anthony Chait, as Stan mentioned, and me, together with my colleagues, are from Ziridium, which is a niche tax and exchange control consultancy, which started in 2003, so 21 years ago, but we're still waiting for the key to the door. Joining me today is two of my colleagues, George Hornsby, who the newest member of our team, but has done a lot of research into the history of exchange control, which he'll be sharing with us shortly. And then Mike Kirsten, who is celebrating 10 years with Ziridium, in fact, having joined almost immediately after his retirement from the South African Reserve Bank. And he'll have some comments about his career at the bank, and particularly when he first started and when he found himself in the exchange control department. And in terms of the questionable longevity of exchange control, Mike will share with us some comments that were passed at the time. So it's good to be with you. We, of course, welcome questions, which we'll all endeavor to answer. And the mechanism for putting forward these questions is to use the chat, and together with Danny, we will go through those questions and answer them literally as they come up. So we encourage you on any topic or any aspect to feel free to post up some questions. So the title, and Stan's obviously more of a Latin scholar than I am, but my understanding of Quo Vadis is really, in terms of this exchange control, and you'll hear from George in a moment how long it's been around, where to now? Do we have a sense of direction or purpose in terms of exchange control? So let's kick off by turning to George straight away and posing to him the question, George, what is exchange control?
Good afternoon, everyone. My name is George. Thank you, Anthony, for the question. Okay, exchange control. What is exchange control? In simple, exchange control is fear.
Right. Okay. I think that fear, it's either fear or flight, and flight comes into capital flight. But with the historical background of exchange control, going back to legislation that dates to 1933, could you share with us some of the research around the time, 1933, that led to this legislation being put into place and on our statute books.
Perfect. Thanks, Anne, for that. So the historical background for the South African Exchange Control Currency Exchange Act of number 9, 1933. The main reasons for it was the Great Depression. During the 1930s, the globe faced an economic recession, and it especially hit South Africa very hard. There was a significant decline in commodity prices and in international trade. As well as that, the South African's currency was directly tied to our gold. Due to economic pressures, South Africa decided to abandon the gold standard in 1933. Some of the key changes in 1933 as well included that the currency was devalued by abandoning the gold standard. Thus, it made South African exports a lot cheaper and aimed to boost the economy. The goal back then for the exchange control was to stabilize the economy and to protect foreign currency reserves, as well as to protect capital flight and regulate foreign exchange.
Wow, George, thanks for that. And I've actually, and having taken exchange control almost for granted, having worked in this environment for some time, I actually learned some things based on the research that you did, and particularly the Depression and the Great Depression, which I heard a lot about, was told about it by my late mother, but wasn't aware of the role that the Depression played in the introduction of exchange control. So I guess the next question really relates to 1939, and that was sort of the pre-war years, and South Africa was still part of the sterling area. Because I remember as a young boy being confronted with decimalization and the introduction of the rand. So perhaps just give us some insight into the 1939 emergency finance regulations.
Okay, thank you. So in 1939, South Africa introduced exchange controls through the emergency finance regulations as part of the sterling era. Coincidentally, World War II started the same year of 1939 and lasted until September 1945. In October 1947, the Exchange Control Act largely replaced these wartime regulations and continues to serve as the primary legal authority for exchange control today. The purpose of the 1939 exchange control was to protect the foreign currency reserves of the sterling era members, which prevented large amounts of money from leaving the country and going places not aligned with the British Empire, as the Union of South Africa was a British Commonwealth until the 31st of May 1961, where it became a republic country. And could you please speak to us a little bit more about the sterling era and what that is? Because we had a great conversation about that earlier today.
So essentially, and again, the sterling area is, or sterling as a currency, because South Africa in the colonization by Great Britain, as it was, sterling or British pound sterling was the currency of Britain. And therefore, as a colony and as part of the Union of South Africa, as it then was, we all had pounds, shillings, and pence. And that ended, George, as you mentioned a moment ago, with the declaration of South Africa on the 31st of May, 1961, as a republic. And at that stage, the pound sterling as the currency and legal tender was abandoned in the place of the currency that we have today, rands and cents, which was more on a decimal basis, working with the units of 10, as opposed to, as I recall, sterling worked, I think, in units of 12. So it's really interesting to know a bit about the past and how we were part of the sterling area until South Africa's independence, as it were, so-called independence, and leaving the Commonwealth back in 1961.
Yeah. Although South Africa has had exchange controls since 1939, the current legislation is based on the exchange control regulations issued in 1961 under the Currency and Exchange Act of 1933. Now, where this came into place with the 1961 Act came from the Sharpeville incident, which happened on the 21st of March, 1960, otherwise known now as Human Rights Day, where police officers went into a black township and opened fire, killing 69 people. With that, it caused a lot of social unrest. Now, you'll have two options. You'll either have an economic point of view or you'll have a social point. South Africa is doing well. It is a social point that scared people of, where are we going? Where's the future? And that was why we had to put the 1961 Act in to prevent capital flight. Exchange control in South Africa was sometimes tightened or relaxed based on domestic and international situations. Sometimes these controls were extended due to political events rather than economic reasons. Since 1961, exchange controls aim to protect the domestic economy from harmful effects caused by non-economic capital outflows. When will it go? In the words of the current governor of the Reserve Bank, Mr. Lesetja Kganyago, that is exchange control, and it will go when it becomes a non-event.
What, George, just to add to that, and we look at critics, because exchange control has been in place and not everyone has been happy and excited about the existence of exchange control in our lives. And the two critics that we've noted here is one, Professor Brian Cantor of UCT, who is a prolific writer in our financial media, financial press. And I recall his words saying that exchange control, and I quote him, is an affront on human dignity. And I think what he means by that is you should be able to do with your money as you wish, in terms of either keeping it in the country or transferring it abroad. So he was one critic. And then the other, and his name will crop up from time to time in this presentation because it resulted in a case before the Constitutional Court a number of years ago, and that is Mark Shuttleworth, who developed a internet security a verification system and sold it for a huge amount of money. I seem to recall then 2 billion rand. And he sought to move that offshore and bumped exchange control, and then had to actually emigrate. He felt he was forced to leave the country that he loved and financially emigrate, just in able to mobilize his wealth. So he too is noted as one of the major critics of exchange control.
Yeah. So the factors pointing to the removal of exchange control. In terms of the World Bank and International Monetary Fund, South Africa got advice from the World Bank and IMF to loosen exchange control. South Africa chose a gradual approach instead of a sudden change.
Pause for a second. I want to just check. Sorry, someone was complaining they lost sound, but it was seemed to be their own cell. All right, no
Okay.
problem. We'll carry on.
All right, perfect. Okay. South Africa chose a gradual approach instead of a sudden change. So the two changes that we have, or the two approaches in terms of removing the exchange control, the first approach that we have is from the UK. Now, in 1979, Margaret Thatcher removed the exchange control overnight with the sweep of a pen, which meant that citizens could move money freely. The risks that imposed was capital flight if confidence was misjudged. But the benefits in that included as well, they could boost confidence and attract inward investment. Now, the second option, which was the South African route, we chose to gradually phase it out. This reduced risks associated with capital rights and by doing it in gradual steps. The conclusion for this, each country decides the best method for its situation. The UK and South Africa show different ways to handle exchange control removal.
Great. Well, thanks, George. Again, and I was always a fan of Margaret Thatcher, and so a lot of admiration for her taking that bold step. And there were a lot of other reforms in the UK that she brought about, tax reform, because I recall prior to her coming into power, the top rates of tax payable by individuals in the UK was somewhere in the region of about 72%, and high corporate tax. And a lot of UK corporates actually fled offshore and established them in countries like Canada and so on. So there was a lot of good that Margaret Thatcher brought about. And one of them, as George mentioned, is overnight abolishing exchange control, which was in the UK for 40 years, 1939, as we saw, around about the time of our enactment of the legislation, to 1979. And when the Brits woke up one morning, it was gone. In South Africa, we're waiting for that day that Governor Kanyako has mentioned that when it becomes a non-event. So let's wait and see. Looking now at the organizational structure with exchange control and how it's administered. So the ministry where this belongs is obviously the finance ministry, and the civil service or the government department that reports to the Minister of Finance is obviously National Treasury. And you'll see Mike will deal with some of the latest pronouncements and circulars, and you'll see the role that National Treasury play in the whole thing, certainly in terms of the policy. Yet the day-to-day administration of exchange control is administered by the South African Reserve Bank, yet through a network of authorized dealers who are typically the banks, the majors, ABSA, FNB, Nedbank, Standard Bank, Capitec, and then some of the smaller ones. Might touch on that in due course. So, and I think what's worth mentioning at this juncture is that any individual that has an exchange control issue of any type, and we'll see shortly what sort of applications and instances, regularization, for example, one cannot go, and this was something that Mr. Shuttleworth complained about at length. He wanted, and he felt he'd have a right of access directly to the Reserve Bank, given that they're the administrators of exchange control. And that's not the case. One has to work in all instances through the network of authorized dealers. And as practitioners in this field today, we have some difficulty with that because exchange control, as you've heard and as you'll see, is a fairly complex set of rules and regulations. And we find within the authorized dealers, and whilst they're most helpful at times, there are pockets of expertise. And if one is fortunate enough to encounter people within the banks that have such expertise, that is great. But there are also areas of huge frustration simply because this is a complex area, and there's a lack of knowledge of exchange control amongst the very people who are tasked by the Reserve Bank to administer and to deal with us, the public, in terms of any aspects of exchange control that affects our lives. We're going to look now at the various milestones in this timeline that George mentioned of the gradual phasing out of exchange control. And there's some notable milestones which we've sort of called the relaxation over the decades, because it seems to be that although there's been a clear ongoing process of relaxation and exchange control reform, we'll see that the department at the Reserve Bank, the Exchange Control Department, isn't even called that anymore. It's been given another name, all as an attempt to show that we're trying on a gradual basis to move away from the original set of rules of exchange control. So most notably over the decades is the October 2010, as part of his medium-term budget framework, or mini budget as we sometimes call it, the then Minister Pravin Gordhan announced some fairly sweeping changes to exchange control. They were all very positive. And 2010 was a very good year, if you recall. It was the year that South Africa hosted the FIFA World Cup, and our economy was certainly very buoyant, and heralded the opportunity to make these changes, which we're going to cover shortly, and they relate primarily to the allowances and the changes in the allowances that individuals are able to take out of South Africa and invest abroad. Then, almost 10 years later, the then Minister Tito Mboweni announced significant changes to our immigration rules. We're going to discuss that as well, where the concept of what we've known up to now as financial immigration was actually abolished. It took some time to come in, and those changes really took effect from 1 March 2021. But it was in his budget speech in February 2020 that Minister Mboweni took that bold step of abolishing immigration. Again, just covering what a previous slide dealt with, and just the administration, and it's really a repetition that the Minister of Finance delegated the exchange control regulations and the powers of National Treasury to the South African Reserve Bank, and those in turn are carried out. And there are various of these functions that, in fact, previously, in our experience, were handled at Reserve Bank level, and now, particularly when it comes to, for example, an inward loan, if a South African resident wants to borrow from a foreign bank or a non-resident, then nowadays that is simply handled by the banks themselves as authorized dealers. just on that particular example. An inward loan, there's usually a 14-day turnaround period. It's dealt with, provided it's a vanilla loan, and you submit the loan agreement and so on. It is handled at authorized dealer level. They'll give you approval, they'll give you a 16-digit ID number, and then the funds can be introduced into South Africa and reported through the BOP, that's the balance of payment system. So all of that done, as well as many other functions by the authorized dealers. Some source material that we rely on, and we're going to touch on this as well through the presentation, because this is where we just direct you if you wanted to read up or know more about what exchange control is all about. How do we as practitioners deal with this, and where definitively can we find out about exchange control. So three specific sources are mentioned on this particular slide. So in 1961, in fact, so there was a bit of a delay, and then probably on the back of the Sharpeville incident that George mentioned earlier, the tragic incident in March of 1960, the actual regulations were gazetted, and a lot of those and the principles of those about restrictions on individuals in exporting currency and so on are contained in those regulations. But that was the regulations are somewhat dated, but what is kept current and up to date is the next document, and you're going to hear a fair amount about it during this presentation, is what we in the industry call CMAD, which is an acronym for the Currency and Exchanges Manual for Authorized Dealers. It's been it's updated from time to time, fairly recently, in fact. And the most recent version, which is available on the website, was updated on the 12th of July 2024. And then what feeds their way into the CMAD document would be the exchange control circulars. Mark's going to talk about those. We hear about those usually at budget time, but sometimes throughout the year as well. Mike will tell us the purpose that is served by those circulars. Okay, George, did you want to add to that?
Yeah, perfect. Thank you for that, Ant. Okay, so for the CMAD, if you guys would like to read up on this while we are talking about this, we have a QR code at the top there that you guys can take a picture with your phone, and it'll take you to the circulars on the Reserve Bank website. And these are the ones that we have just basically cherry-picked of topics to talk about. We have a Q&A afterwards, so if there's any questions, please write it down and we will answer all your questions after the seminar.
Okay, thank you, George. So, and I think there's some more QR codes. Probably the younger members of our audience are more familiar with the use of QR codes, and some of the other source documents towards the end, you'll find those QR codes, and they take you directly to the link of the various documents. Mike, before we leave the topic of exchange control circulars, perhaps give us some background. You've had a lot of experience with these circulars. So some of the more important ones that we've listed here, and then for what we noticed in this year's budget, for the very first time in the history, in fact, of exchange control, is that the circulars were issued in February in draft form. So perhaps tell us more about that.
Okay, thanks. And my name is Mike Kirsten. Good afternoon to all. Afternoon already. Maybe just to go back to one of the previous slides where the current governor made the comment that, you know, the exchange control will be abolished when it becomes a non-event. I joined exchange control. It was then known as exchange control in 1978. I asked for a transfer from the branch to this department because I felt it a little bit more challenging than what I was doing. And I was told that was a bad career move because within a year, that department will be shut down and will be no longer be in existence. 45 years later, we're still here and we're still liberalizing. And so it carries on. You know, there's no big bang approach. Like what happened in Malaysia, I think they did the big bang approach without any interventions or records of cross-border flows. And it was a disaster economically for them. The Reserve Bank brought in a massive cross-border flow regime. Any in and out flows are reported, whether it's R1 or 1 billion. And that's critical to formulate, you know, future economic policy, et cetera, et cetera. Maybe just touch on a few other milestones before we get to the circulars. 1976, Uprising Soweto, the introduction of securities rand. I'm not too sure what the age of the audience is, if they even understood or were aware of securities rand, which was a second exchange rate. 1978, the COP Commission on Securities Rand broadened into something called financial rand. Dual exchange rate. It was a nightmare, created kite flying and round tripping and lots of transgressions. 1983, exchange controls over non-residents was abolished. I think that's important, which then also implied the abolition of the financial rand, because the financial rand and the commercial rand then became level playing field. 1985, debt standstill. 1994, obviously the first democratic elections, and then in 95, the final abolition of financial rand and any controls over non-residents, but still in place over residents. Getting back to the circulars, I think Anthony mentioned, let's go through those circulars very quickly. In 2020, there was a statement on the new capital flow management framework. That changed a lot. That was changing the current negative bias framework to a positive bias. And that would apply to the regulations as well, not only to the manual. So that was a move in the right direction.
Mike, could you explain what, for those of us who aren't familiar with the negative bias versus the positive bias, perhaps some expansion on that?
Okay, so the negative bias, and if one goes to the 1961 promulgated regulations, it means you can do absolutely nothing except the following. Changing it to a positive bias was the exact opposite. You can do everything and anything except the following, you know, 1 or 2 or 3. We're not there yet, obviously. I mean, those regulations need to be updated. And I think the SARB have been working on this for a long time. Any other?
We've had some questions which I'll turn to, but perhaps do you want to
let me carry on.
Yes,
I'll go to the next important circular, which is the immigration circular. And Anthony mentioned this is where they phase out immigration. It's now totally sort of in the hands of SARS as opposed to SARB. In those days, you filled in a form called the MP336B, and that was fairly straightforward, you know, and you could backdate immigrations if people hadn't done this formally. Today, you can't do that. But I think the whole purpose of that particular circular was to create natural affinity between residents and immigrants. We didn't agree with that initially. We thought it was, it was an onerous and a difficult thing to administer. But SARB don't administer that anymore. It's done by SARS. And that's where you get the tax clearance certificate and all the new things that need to be complied with, mainly tax-driven. And I think, you know, one has to bear in mind, this is not tax-driven, immigration-specific. To me, an important circular was the 2022 circular. retention of foreign gifts and other authorized foreign assets abroad. You could never do that previously. You could not make funds offshore available to an SA resident. You can do that now. If you get a donation, you can do that now. You're exempt from regulations 6 and 7. To me, it was a huge plus. People don't sort of realize that, I don't think. Any other questions so far?
And I can carry on with the discussion on the circulars.
Okay, so they reiterated those changes again in 2023 under circular number 6 on the foreign currency holdings, foreign earned income, donations, etc. And then, as Anthony mentioned, the very last budget speech created, after every budget speech, there's a statement attached to the circulars which is sent to the authorized dealers with the changes and the proposals. This year, for the very first time, they sent out 4 circulars asking for comment from the authorized dealers and the public and any interested parties, which they will refer back to the National Treasury, because at the end of the day, the National Treasury, they dictate policy, Reserve Bank implements policy. And that hasn't been finalized. And I think the important one there is the royalty agreements between resident and non-resident related party. If there was a related party in the past, you needed SARB or Financial Surveillance Department approval. The intention is to do away with that restriction. And we're all waiting with bated breath to get the final go-ahead on that particular circular. That hasn't happened, so that's pending. So currently that means applications of that nature need to be referred via the authorized dealer to the SARB. And then exchange control circular number 7 is just the withdrawal of BNP Paribas as an authorized dealer, because a lot of the banks are now pulling out. And most of the circulars involve changes of ADLAs, which is authorized dealer with limited authority, and ADs. The background to circulars is there's a lot of, well, there were a lot of meetings, technical committee meetings between SARB, SARS, in those days, SICA, and even the Law Society to formulate whatever was best for the marketplace. So it was consultation. Still happens today. They have technical committee meetings with the banks to look at the practicalities of the mooted changes. But nowadays, it has to be sanctioned by National Treasury, which can, to a large extent, create delays. Thank you.
Mike, if we've completed the discussion on the circulars, perhaps I would, at this point in time, first of all, acknowledge and thank the 2 participants who have posed questions. They're both very interesting questions, and I'll deal with them because we have covered aspects of this already in the presentation. So, Luke, if I may address you by your name, writes, if you borrow abroad for business, what rules apply? And that's a very relevant question, because that relates to what we call inward loans. And there's a bit of history to share with you on this, because previously borrowings from abroad by a business or by an individual, and technically that's referred to is by a resident borrowing from a non-resident. And a while ago, those were all handled at Reserve Bank level. And then as part of the delegation of powers, and it's fairly simplified, a system was introduced called the RLS, the Reportable Loan System. And the banks were geared up to handle these. And so, Luke, you asked what rules apply. And quite simply, in order for a business to borrow from abroad, it approaches its authorized dealer. That's the bank through which it conducts its normal banking transactions. And the sort of rules that apply is that the bank would need to know details of the lender, and what the nature of that loan is, what are the terms of repayment, what are the interest rates that prevail. And there it's quite interesting, because the Reserve Bank has a policy of applying different acceptable levels of interest rates depending on who the lender is. So, for example, if the lender was a related party, for example, a foreign parent company that was lending to its local South African business, then a certain interest rate would apply. Or if it was just a third-party financial institution or lender, where it was easier by that business to borrow abroad in foreign capital markets, then there could be another benchmark set of interest rates that the Reserve Bank, through the authorized dealer, would be happy with. And one needs to just understand what those different rates are. They used to be called or linked to the LIBOR rate, which I think is now called the SOFR rate, particularly in relation to US dollars. And you then just need to tell the bank what the agreed rate of interest is between the lender and the borrower, and if that meets the benchmark that the bank is happy with, then that loan will be approved. And as I mentioned earlier, that takes about 14 days if it's fairly vanilla. We have had instances where there are complications. For example, there may be a premium or premium rate of interest, or the loan may be in the form of a debenture, which has options to convert to equity. And where it's outside of the vanilla type of borrowing, then the authorized dealer may just say to you as part of your application, look, this is outside of our authority, and we need to pass this one up to the Reserve Bank just to guide us and to confirm that we can approve this loan. Then you're looking at longer than the 14-day period. And sometimes those can take between 6 weeks and 3 months. And very often it's urgent because you need those funds for your business. So there are ways in which one can expedite it and communicate with the Reserve Bank to say, look, you've got this application. It is rather urgent. Please approve it. And either what would happen is the Reserve Bank would come back with either further questions or areas where they are unhappy, or alternatively, they would, if they're satisfied, confirm to the authorized dealer, and that approval will come through. And it's interesting from an exchange control point of view, those who've not dealt with incoming loans, the lender then introduces the foreign currency into South Africa through the bank's Nostro account, which is every bank has a Nostro account of a foreign currency. And then you'll be contacted by your bank to say some funds have arrived. What is the purpose of these funds? And you say, that is the loan which I've had approved. And then you report the 16-digit ID number that loan is afforded. You report the incoming funds, and on that step, the bank will convert the foreign currency into rand and will then be available for use by your business. So, Luke, hopefully that answers your question and gives you an indication of what the rules are that apply. Mike, did you want to comment on the RLS?
Yes, I think once again, bearing in mind, any inward loan or repayments are recorded on this massive mainframe, so and if there's a manual override, for instance, there's no repayment, they have to change it and do it manually. But I think just to add to Anthony that in two important aspects is relationship between the borrower and the lender. They look at that quite closely. And then the interest rates are based on whether it's a shareholder's loan or a third-party loan. And the difference there is they allow a bit more leeway interest rate-wise. It's 3% above LIBOR or the base rate of the country of origin of the denomination. Those are your two main. They may call for a loan agreement in some instances, but that's not generally the case.
That's it. Just dealing with the next question from Nectarios, and thank you for that question. Slightly, and we haven't come to that is almost in the next slide, but the question reads, are there any tax implications by moving your funds in and out of the country as an individual? And that's a good question. And tax is perhaps a little outside the ambit of this presentation, which is really exchange control, but very often it's quite seamless where there are exchange control implications and consequential tax implications. So the answer to this question fairly simply is that if you want to move your funds in and out of the country, and here mainly out of the country, then the tax implications would relate to the source of those funds and how you came to arrive at those funds. And if, or to the extent that you sold an asset, a property, shares, and had an aspect of liquidity and then wish to move those funds out of the country, then the question that arises from a tax point of view is, what were the capital gains in relation to the disposal of that asset that gave rise to the funds, and that as a consequence, there would be capital gains or possibly capital gains tax payable. I mean, if it was your own primary residence or house that you live in and you sold that, if the gain was under 2 million rand, of course, then whilst there is a capital gains tax implication, it is zero and nothing to pay. Claude, thank you for your question, but that relates to financial immigration, and we are going to deal with that presently. So if I can ask you just to bear with us, and we'll get to your question. And Luke, just I guess before we leave the one about the inward loans, and he's asked perhaps a new question, not going to be covered necessarily, so we'll answer it. Is and might I call you in wearing your former Reserve Bank hat? Luke asks, what is the role of the Basel Committee? So the Basel Committee, which is really a grouping of banks, and after the global financial crisis, I think they became quite involved in recommending prudential limits and the amounts that banks had to retain as part of their own capital funding. So was there anything you want to add about Basel?
No, that's a prudential authority mandate. So it'll fall under the old bank supervision, liquidity ratios, etc., which is now called prudential authority.
Right.
It's not really an ex-con issue.
But Luke's asking about the Basel Committee, but I think for now, we can just tell you, and from my days as a director of the Reserve Bank, a lot of the governors used to go to meetings around the world, to the US, but to Switzerland, where Basel is. And as Mike says, it really relates to laying down the safe or prudential limits that a bank is able to lend against in order to protect its own solvency levels, that in short. So let's continue with the presentation, and we'll move to the next slide. But again, keep those questions coming. Charles will get back to you shortly on your immigration question.
After this break.
And are we going to take a break shortly as well? Should we deal, I think, with the allowances first and then perhaps take the break? Mike, would you take us through these allowances and perhaps given the milestones that we mentioned a little earlier, and particularly the October 2010 milestone, tell us about these allowances which appear on our slide now, and where we came to previously.
Okay, the first one is the SDA, the single discretionary allowance, the 1 million, which in fact is actually a travel allowance. But you can use it for any legal purposes without having to acquire a tax clearance certificate. So that's the one most people should go for, without any tax implications. Just to give you a bit of a modernization or a liberalization, a timeline. In 97, that was 200,000. In 98, it increased to 400,000, 99, 500. And eventually it got to 1 million in 2010. And I think that's where it stayed. And I know Anthony has approached the Treasury or even the SART to say, hang on, 1 million, come on, it's been in place for 14 years. Can't we increase it to 2? And I'm not too sure. There wasn't much positive response to that.
There is an organization currently in South Africa, body, which is called ASISA, and which is the Associations of Saving and Investment Societies in Africa. South Africa is the acronym, which replaced the Life Officers organization. And they've done a lot of representation to the authorities on increasing the 1 million allowance, simply because the rand has depreciated steadily, certainly over the last 10 years. That is just a fact of life. And therefore, the amount of foreign currency that you're able to acquire with your 1 million rand has diminished. The official response, whilst acknowledging that this level or amount was somewhat out of date, was that there was a desire on the part of the Treasury to curb the amount from a prudential point of view that was invested in offshore investments. Pardon me, and therefore it was decided for the time being to retain the level at 1 million rand. But as Mike said, it used to be called, prior to 2010, it was the travel allowance. It was an amount of 750,000 rand, and they broadened the scope, increased it by 250,000, and called it an SDA, or single discretionary allowance. It can also be used to make gifts to non-residents and loans to abroad.
Payable or non-payable?
Payable in terms of
the loan.
Yes, well, there'd be loans which could be repayable. Yes, in other words, because otherwise, if it wasn't repayable, that would really constitute a gift. And very often we find a question, and this leans a bit on the tax side, is if I make a gift, what are the tax implications? And the answer to that, if you're wondering about the tax implications of making a gift to someone abroad of 1 million rand, is the current exemption, annual exemption from donations tax or gifts tax, is 100,000 rand per taxpayer per tax year. That's a limit that's also remained unchanged for many, many years. I can recall it being 20,000 and then 30,000, but the needle seems to have been stuck at 100,000 for some time. So if you're donating or gifting 1 million, there may well be tax implications. And if SARS could knock on your door and say, well, if this is a gift, totally gratuitous, then we might look to you for 20% donations tax. There is an exemption that sometimes people rely on from donations tax, and that is if, and the commissioner, that's the SARS commissioner, is satisfied that you're really contributing an amount to someone's maintenance, perhaps education, then it's exempt from donations tax. So it all depends as to who you're giving the 1 million to and for what purpose that would possibly have a tax consequence or not. Mike, do you want to continue with the 10 million? Or
can I just sort of add on to the SDA? As I said previously, the travel allowance, in fact, currently the travel allowance, and subject to all those conditions, which is crazy, you know, the passport, cannot buy Forex 60 days in advance, etc., etc. And the problem is, if you've used your 1 million for investment purposes, you've got nothing left for travel. What now? So you need to apply for a travel allowance, which is bizarre. But it should never be turned down. It should be a matter of just tick approved, you know, against the normal documentary evidence.
And what we do in practice, Mike, on that very point where the travel allowance and as I alluded to earlier, your 1 million rand at current rates of exchange doesn't go very far, particularly if you're accustomed to staying in luxury hotels and so on, is if you're connected with a business, and we do this quite often, one applies through the business for what is called an omnibus allowance,
as well, yes.
Which is not limited to 1 million, but there are certain terms and restrictions on the use of an omnibus allowance. But that is a way around the limitation of 1 million if you're traveling for business purposes. Just before leaving the subject of the SDA and going to the next allowance, Jerry has posted a question, a very relevant question, and thank you for this, Jerry. And it's asked, if money was taken out using the SDA and deposited in a foreign bank account, must they be brought back in the future? And the answer to that, Jerry, is no.
Absolutely not.
It's an allowance. It's there to stay abroad permanently in your foreign bank account. And there's no obligation, certainly under current exchange control regulations, to have to repatriate those funds at any stage in the future. Those funds have been externally permanently externalized and can remain in your foreign bank account. I should just, as I mentioned, and we'll flip between tax and exchange control fairly often, if you're earning interest in your foreign bank account, then there's an expectation on the part of SARS, if you're a South African resident, that you account for that foreign interest. But yeah, once it's externalized under the SDA, and it applies to the capital allowance that you're going to come to now, the 10 million, it's permanently externalized with no requirement to be brought back at any stage in the future.
Okay, just to add to that, you know, if there's a family of 4, 2 kids over the age of 18, you can take out 4 million, you know, it's per individual. You have to be over the age of 18.
Yes, correct. And no tax clearance is required, because we're going to segue into the next capital allowance in a moment. But as Mike said, you can bulk up. If you have a family over the age of 18, then you can get 4 million within that family grouping. Mike, the 10 million.
So, similarly, the 10 million, each individual is entitled to 10 million, but then that's subject to a tax clearance.
Sorry.
I just saw another question about the SDA before we move on.
Okay.
I think from Warren. Did you see
From
that?
Warren.
Yes.
All right. Okay, let's answer the question from Warren, guys, and then we can take it forward from there.
Warren, very good question. And wow, we see this so often. So Warren writes, how about the 1 million SDA and then use of RSA credit cards abroad? And what I think is important is that as part of your 1 million SDA, you can either acquire foreign currency and remit it abroad, or simply use your South African credit card abroad, provided you don't exceed the 1 million rand per annum. And you may be wondering, how does the year run? Is it the tax year? For these purposes, and from an exchange control point of view, the year is the calendar year, which runs from January to December. So it has nothing to do with the tax year. And the allowance resets every year. So in January, you get a fresh allowance of 1 million rand if you've in the previous year. It doesn't, it's not cumulative in any way. So in other words, if we're now in 2024 calendar year, if you didn't take your 2023 allowance, if you snooze, you lose. It doesn't mean that you can now go to the Reserve Bank and say, I'd like 2 million, last year's plus this year's. It doesn't work that way. So there's always, and we're usually quite busy around about December, where people suddenly wake up and say, I haven't used my allowance for the year. Let me quickly send it abroad. And very often the rush is around about the 27th, 28th of December. It's in the middle of the Christmas and New Year summer holiday period in South Africa. The banks are short-staffed and so on. And I recall over many years this big scramble just to avail of the allowance before the new one kicks in. Back to Warren's question, though, he talks about the relationship between the SDA and the use of RSA credit cards. And as I've mentioned, the 1 million single discretionary allowance includes the use of a credit card. You don't get the 1 million over and above. And the Reserve Bank operate a very stringent exception reporting system,
which records every credit card
spend. And I've seen time and time again where clients come to us because they get a fairly rude letter from their bank, and you can exceed the limit by something even as paltry as 1,000 rand, and the bank will jump on you from a dizzy height. So just bear in mind, if you're using your RSA, if you're going on a trip and you're using your South African credit card abroad, you must deduct that from the 1 million SDA, or you will face the wrath of the Reserve Bank.
If you exceed the 1 million.
Anthony, also, I want to just maybe add on to this, or just question. So, like, will that use of the credit card also apply then to online purchases? Because I've seen others who deal. So, like, if you buy something internationally, like from someone was even questioning me on, say, like Netflix, where you buy, or one of these other, online streaming services where they're based in like a foreign currency, and now you use your credit card. Will that also not attract part of or subtract from your single SDA?
No.
That's an import. You're paying for an import.
Yes. Or Mike, I remember the allowance came in, it was 20,000 at the time.
50, yeah.
Is it 50 now? So that's for what they call internet transactions.
Yes.
Specifically because now you can buy, and we've all seen the emergence of organizations such as Amazon and so on. So if you want to buy something from abroad, and you may pay for it with your credit card, but it's an internet transaction, then that doesn't form part of your SDA. So coming back to Warren's question, that's the 50,000, I think, per transaction is permissible, and it doesn't in any way impact your SDA. So I think the use of your credit card abroad is what we've seen is if you travel, so you settle your hotel bills, restaurants, all your land arrangements and your out of pocket. So Your airfares per se, if for international travel, do not come out of your allowance, because presumably you'll
Right,
pay that in
locally,
rand to any of even the foreign airlines that are represented in South Africa. They will accept rand, but it's once you've left and you're on holiday and you're using your South African credit card, that's when you need to bear in mind that your SDA is effectively being reduced by that. Now, just from our own case files, a number of years ago, we've had instances where people have exceeded the R1 million through use of a credit card, but 2 or 3 people have been part of the same party. I remember one specific instance where different people were traveling together, and the credit card of the one person was declined, probably because of the Falcon system, the bank's Falcon system, which was in the news last week because of this massive outage that was encountered worldwide. So the person whose credit card was still continued to be satisfactorily presented, they just ran up, and in fact didn't think anything of it until the bank sent them this less than polite letter. We took it up with the bank, and in fact was passed on to the Reserve Bank, that and we explained that there were in fact 2 people traveling. There could be 3 people traveling. So the point that Mike made earlier, then the allowance is really 3 million, and we were able to explain that one of the credit cards was constantly being declined, and that was the reason that one person exceeded the SDA. And the Reserve Bank were quite satisfied with that explanation.
Another example was we had a client that paid the Australian Visa Office with his credit card, and it was quite a substantial amount. And he was taken to task for that because he had exceeded his 1 million. But we resolved it eventually.
Yes, yes. So as I mentioned, it works on what can be called an exception reporting basis. That will flag, and the bank then writes, they just get the report, and the Reserve Bank will provide this to the authorized dealer and say, this is your client, because it's usually the bank that has issued the credit card. They're the ones who have to deal with their customer on this. And as I said, they are reasonably understanding if there's a very good reason. And I've mentioned, and Mike's mentioned some of them. Malcolm has asked the question about the SDA and whether that forms part of the AIT 10 million. And that's happily, Malcolm, we can tell you that they're separate. So in fact, Malcolm, your point is a good one, because you actually get 11 million as an individual, 1 million through the SDA, which is automatic, and 10 million via what is now called the AIT. We're going to talk about that at length in a moment. It doesn't form part of it. It's over and above. So call it that you get 11 million per annum. We're going to talk about the supersized. I'm also conscious of the time. Danny, should we just continue before the break?
Yeah, I'm not too sure how long you're going to talk on the 10 million, but because it's, well, I was just thinking we were going to take an hour every hour, but
it shouldn't take long.
Should we then we'll take a longer break in when we're done.
Okay.
Yeah.
Let's finish the slide with the allowances, and then have a dessert break. And if you want to run and switch the kettle on or whatever, we will give you some time, and you won't miss anything. The 10 million. It was called the FIA, Foreign Investment Allowance, right up until April of last year. And there's a document which we're going to share with you, a SARS document, because the 10 million is really subject to tax clearance. So the Reserve Bank relies on SARS to administer and to determine eligibility for what is now called the AIT approval for international transfer. That was the new name given to the foreign investment allowance in April, May of last year. And the tax clearance, and I'll give you a little bit about the history of the tax clearance. So the 10 million was always subject to tax clearance, whereas the SDA is not subject to tax clearance. And over the years, because this came in 2010, and I'll give you a little bit of the history of that, is that the 10 million, before October 2010 and before Pravin Gordhan's watershed mini budget speech, the allowance was originally 2 million, and then it became 4 million. And in fact, in the October speech, the main change regarding the 4 million is that it was a lifetime allowance, once off. You could get it in drips and drabs, but once you hit the ceiling of 4 million, that was it. You could export no further capital from South Africa. And what Pravin did as part of his October 2010, and it remained 4 million, is that 4 million became an annual allowance.
Yes.
And then the very next budget in February 2011, the 4 million was revised upwards quite generously to 10 million. And it's been 10 million ever since. But subject to a tax clearance. And in fact, what those tax clearances were always issued by SARS. They were issued manually. There was a number of officials in the various branches of SARS who were charged with the responsibility of issuing those tax clearances. And you then had to give a list of your assets. Sometimes they reconcile those assets with the assets and statement of assets and liabilities that you'd told SARS about, but very often they didn't. And invariably in those days, it was a lot easier, and SARS gave you the approval for the FIA fairly readily. Until last year, around about April, and in fact, SARS adopted a much stricter approach of follow the money, I think is what they colloquially called it. And what that simply means is we have no problem in you exporting the 10 million, but you need to show us where you got the money, the source, and have you paid your taxes? So this is back to the point, and in relation to an earlier question of if you'd sold assets, then there's an expectation that you'd accounted to SARS for the capital gains tax, and invariably you'd need to show SARS where in your tax return you had reported that capital gain, and SARS were then happy and they would give you the approval. A couple of comments about the AIT currently. A professional colleague reached out to us earlier this week about an AIT saying they wanted to make an important investment abroad. Applied on the 8th of July. They then were asked to submit certain relevant documents. And they then came to us and said, I haven't had the approval yet. And we said, you really need to be patient here,
for sure.
because SARS are entitled, and I think this is a part of the POJA, the Promotion of Justice and Administration Act. SARS are at least entitled to 21 working days to consider your application. They may very well come back with certain questions, and very often we find in the average with regard to SARS approval for a AIT is anything from between 6 weeks and even 3 months. And if you called upon for supporting documentation and SARS are not satisfied, they will decline. Other areas where we've seen the AIT declined is on aspects of non-tax compliance. So you might have not submitted in a previous year to not submitted a provisional tax return, or you might have a business and you have VAT returns outstanding. And unfortunately, you don't get the reasons. You'll just get a standard computer-generated letter saying your application for AIT has been declined. And then you have to call the call center, and then they say, you know, there are VAT returns that are outstanding or whatever. So you need to be fully tax compliant, good standing in every respect, in order to get a successful AIT. But they are being issued, you know, there was a lot of suspicion that SARS are just making it more difficult for people to take their money out the country. That's not our experience. If you're in good standing, then, and it might take a bit of time, then you'll get that approval. And Claude has commented, and he's quoting SARS Commissioner Mr. Kieswetter, who in an interview, I didn't hear that interview, but he said the taxpayers applying for the 10 million must expect a full audit. Has anybody had experience in this triggering an audit? So, Claude, in our experience, it's a limited audit, because I want to now move, and this is a good segue to the next allowance, what we call, this is our, it's not called this, the supersized allowance. Days gone by, you could supersize a McDonald's burger, but you could also supersize your AIT and apply for what we call 10 million plus. And we've handled applications for 100 million, 200 million, yeah. 300 million, 800 million, and even a billion rand, yeah. Billion with a B. So, but there, and to the point, you will definitely encounter much heightened SARS scrutiny, and on that basis, you can expect an audit, and therefore that audit generally takes a lot longer. We have one currently ongoing for about 80 million is the application, and it's never ending. The exchange of correspondence between us and SARS on various aspects is just amazing and sometimes frustrating. So yeah, so there's the supersize, just before we do take our break, does attract a much greater level of scrutiny. But again, and I mentioned we have these successful applications because if you are fully compliant, then SARS will allow you. Mike, the Reserve Bank has a role, yes, and perhaps you want to comment.
Indeed, yeah, SARS will refer it to the Financial Intelligence Center as well as the SARB to have a look at the risk management part of it. So, you know, there are lots of parties involved, and hence the sometimes the delay. But if it's all kosher and you're above board, it will eventually be approved.
I was just mindful of the one outstanding question, and Claude's been waiting patiently, and perhaps before we take a break, let me deal with Claude's question. It relates to financial immigration. We're going to cover that after the break, but he says after the immigration, if there's still loans to South African companies, must this then get reported to the Reserve Bank? And if so, and when? Claude, this is very specific in that, has the person financially immigrated under the old regime, under the MP 336 that Mike mentioned, or is it under the new CTR? I think that we are going to cover this, and we will answer your question. We're mindful of your questions, so just bear with us until after the break. Danny, do you want to tell us how long we've got to get that cup of coffee before we reconvene?
All right, I think let's take a 10 minutes or 10 hours.
15.
15, okay. Yeah. I'm
These
just trying to
youngsters here need
do
a
the
break.
maths. Yeah, okay. So, or should we just make it a? Okay, so we're gonna reconfigure at
1:45.
yeah,
No, that's
yeah,
22.
22.
yeah. So 22 minutes to
22.
to 3. Yeah.
All right.
Okay.
Don't go away. We've got lots more to share with
Lots
you.
more.
Enjoy the break.
All right. While I'm talking to you, George, I see you got a timer on your screen. Do you want to set that for 15 minutes and then we can keep a,
Oh, great.
Keep a-
Okay, I thought no one could see that. That's great.
yeah, we'll set that for 15 and then people
How do I
can,
take that? How do I play and then just minimize? Great stuff. All right, thank you, man.
oh, I was going to say, keep it on for now and then,
So now where's the timer?
yeah, you just minimize it. I don't know.
It's okay, no stress. I'll look at the time, don't stress.
Yeah, I just thought maybe to keep everyone to see it, then they could have seen the time. All right, no worries. We'll see everyone in 15 minutes.
Cool.
Danny, will you just
Just want to make a quick call out to let everyone know we're going to be starting again in like 30 seconds. And before we restart, Anthony, there is a question. So if you'll see it, I think carry on from there. But yeah, it's still 15 seconds according to my watch. Don't forget to unmute, George. Okay, yeah.
Okay.
Yeah.
Okay. Right. Seems like everyone is back.
Right. Welcome back, everyone. Danny, you okay that we carry on?
Yeah, it's perfect. I think everyone should be back now.
Yeah.
And just before you start,
welcome back. I hope you had a
Hold
good break. And if you're following the slides, we have advanced a few slides. Don't worry, we will be coming back and covering some of those. We just want you to get the correct sequence to the presentation. So what we're going to deal with now is the new regime to replace the immigration. George?
Sorry, what were you saying there?
I think there was another question with the 10 million allowance. I just wanted to know if you want to
another question.
Okay, let's that's a good time before
we carry on.
This. Yeah.
Okay, let's just see.
On Jonathan Marks.
Okay. Let's just see.
It's still an open one if you're looking on the.
It's the open one. Okay.
Yeah.
All right. And this is from my good friend Jonathan Marks, who I acknowledge and greet. Johnny, hope you're well. And Jonathan asks, assuming you have utilized, let's just read the question, the 10 million AIT allowance or the supersized allowance each year, and accumulated foreign shares and or property in the US or UK, will you be liable for citus tax on your death under US and UK inheritance tax law? And Johnny, thank you. Obviously, we studied together, so we must have learned something for you to raise such a pertinent question. Yes, indeed. And again, your question relates more to taxes, but not out of place in a forum where we're talking about exchange control. And the short answer is yes, indeed. And let's perhaps just for the benefit of the rest of the audience who are not familiar with citus taxes, that really relates to if you invest in a foreign jurisdiction, and what's been mentioned here as an example, and quite appropriately is the US or the UK, where the asset is located, in other words, that's what the citus, I think it's a Latin word in terms of where it's situated, then that jurisdiction could impose taxes on death, for example, of the holder of the assets, because I think the question relates specifically to death. So the US have death taxes, The UK, they call it an inheritance tax. And indeed, both can apply to amounts that you've externalized under either the AIT or the supersized allowance. So one has to bear that in mind. And just on the point of the US, I had a matter recently and tucked away in one of the treaties between South Africa and the US is a double debt duty treaty. Not many people know about it. And it existed, in fact, I checked, it was a 1952 treaty. That's when it was signed. And it was overlooked because in the 1980s, the income tax double taxation treaty between South Africa and the US was unilaterally cancelled by the US as part of their comprehensive anti-apartheid legislation. Then after the new government and the Mandela government of 1994, the US and South Africa sat down and renegotiated a brand new treaty, which is the one that we have in force today, but no one knows and somewhat overlooked because it goes back more than 70 odd years. But there is a treaty. So whilst Johnny is well justified in raising this, bear in mind that there is a treaty for the avoidance of double tax, because otherwise you could have a situation where the South African resident pays his state duty in South Africa, and their taxes that are based purely on the situs of the assets. So just bear that in mind. And Johnny, again, warm regards to you, and thank you for your question. Right, and again, keep the questions coming, because they are really of a level that is great feedback for us in terms of having put together the content for this presentation. We're going to deal now with the new regime to replace immigration. And you'll recall the timeline that we had up in the watershed year of 2020, where the then Minister of Finance, Tito Mboweni, announced that the concept of immigration as such was going to be abolished in South Africa. Now, one or two pointers to the background to this change. It was in an era where a lot of these tax boutiques, and we were not part of them, I must say, who were rumor and fearmongers. And what they did is they put out there that people who had left South Africa many years ago, who had not formally immigrated, could still technically be subject to tax in South Africa. And they called this, I think there was the hashtag 2020 expat tax phenomenon. And of course, that was totally unfounded. But what a lot of people did, who, and again, fueled by these boutiques who really wanted the business, is they rushed to the Reserve Bank to submit an immigration application, the MP336 that Mike referred to earlier, and which in our time, many of which have been handled in this office. And the Reserve Bank were absolutely inundated by these MP336 or blank MP336 applications. And I've no doubt that that was one of the reasons why they thought to abolish the concept of immigration. So in terms of the first point that's being made on the slide, and as of the effective date here is the 1st of March 2021. So Tito Mboweni stood up one day in February 2020, he made this announcement, and then the Reserve Bank and SARS got together for a year to put together what was going to be successor regime, and that then became entirely a SARS affair. The Reserve Bank washed their hands effectively of immigration, and SARS have called it something completely different. So we call it the CTR, and it's cessation of tax residence. Now, cessation of tax residence is really required for anyone who has left South Africa and who wishes to close the pigeonhole and to be recorded officially as a non-resident for tax purposes. Now, we've had a situation where, and we've observed this, that many people who emigrated under the previous regime, and there was quite a rush. In fact, the deadline, as I recall it, and a lot of this took place during the COVID years where the Reserve Bank relaxed the MP336, because previously it had to be a wet ink signed application, which had to go to the authorized dealer and was then sent up to the Reserve Bank. But as part of a dispensation to accommodate effectively COVID, they allowed scanned and paperless applications. And the COVID came in March 2020, as I recall, and the deadline for immigration under the old regime was the 28th of February 2021, because with effect from 1 March 2021, the very next day, the Reserve Bank would no longer accept applications for immigration under the old regime, and just referred any applicants to SARS for the CTR process. And what we really discovered, and this was probably an unintended consequence of the transition from the old immigration regime, financial immigration, as many people like to call it, to the CTR, is that if you had immigrated under the old regime, and this may have been years ago, and you would have at the time applied, because that was a requirement for tax clearance, then SARS would still, to the extent that you still had a profile on SARS e-filing, SARS would still have reflected you as resident. And even though you might have protested that you were non-resident, you'd emigrated, they would require you to complete the CTR process. So we are fairly inundated at the moment with applications of some individuals who immigrated prior to 28th of February 2021, but where their SARS records still shows them as residents. So just bear that in mind if you have any clients who immigrated under the old regime. It is still necessary, and much to the annoyance of your clients, they now need to go through this process. Now, how do you go about, we get lots of questions, even from fellow practitioners, because it's dealt with in a fairly obscure part of the SARS e-filing profile of an individual taxpayer. How do you go about recording and applying for cessation of tax residence? Well, you go into the section which is the maintenance section, and you pull up what they call the RAV01 section of the tax profile. And I think that's a registration and amendments section. And when you look at the status, the default there would show resident, and then you have a drop-down menu, and you can change the status from resident to non-resident. And that is effectively indicating to SARS that you have ceased to be tax resident. Now, the minute you do that, it triggers an automatic electronic letter to be sent to the taxpayer or to the tax practitioner that is representing that taxpayer, which asks a whole batch of questions or calls for a whole lot of information in relation to that individual ceasing tax resident. And to give you an indication of what the requirements are, and what, as it does that, it sends you a letter setting out the requirements. It opens up an upload portal where these documents need to be uploaded to SARS, and a period of 30 days. So from the date of the issue of that request for information for the CTR, you have 30 days in which to upload the relevant information. If you fail to upload within the 30-day period, or you upload insufficient information, then you would just get a letter saying that your application for CTR has been declined, and automatically then under the RAV01, the status is shown as resident again. It automatically defaults back to resident. If, however, it's approved, and I'll outline in a moment the sort of documentation that SARS are after, then the SARS system gets updated from the date that that individual ceased to be tax resident, and forever and a day, that date, all future tax returns will show that that person ceased to be tax resident on that date. Now, the sort of information, and this isn't the exhaustive list, it is available on the SARS website, but things like the departure stamp in your passport when you left South Africa, or that individual, the visa for the country in terms of which they had landed residence rights in their new country, in their new home country, their foreign passport, a travel diary, because if from that date that person has visited South Africa, they want to know the dates and the purpose of that trip. Excuse me. So you would list the dates, and you would say it's either to visit family, friends, or to have a holiday indeed. Then just to ensure that you are indeed tax resident, they would ask for certain information regarding your new country of residence, such as proof of a gym membership, proof of a utility bill, as Mark says, a church membership, and the sort of things that show that you are a resident in another country. Now, in terms of the date, and we are, in respect of people who left some time ago, then it is possible to backdate, and it's important to backdate for a reason that I'm going to mention in a moment, to the actual date of departure. The reason being that prior to that date, you are regarded as a South African resident, and South African residents are taxed on a worldwide basis. And you may have moved to a new country where you're currently employed and derive remuneration. And SARS would be entitled for you to submit details of your worldwide income, including your remuneration in a foreign currency, in a foreign country. It could be subject to the exemption in section 1010, but that's a tax issue and outside of the scope of this particular presentation. So be very careful about the dates that you apply to be a tax resident or cease to be tax resident. Also watch, and we spoke a lot about the SDA. Technically, if you are what SARS, or what the Reserve Bank called a South African resident temporarily abroad, and you have not either formally immigrated using the MP336 or done a cessation of tax residence, CTR, then you are entitled, and remember I said it's not cumulative, to the your SDA. And in the year in which you cease, if you hadn't previously immigrated, the year in which you cease to be tax resident, you're given one last SDA, obviously prior to you becoming a CTR. So bear that in mind if you're dealing with someone. There is an opportunity, if you haven't availed yourself of it, of the last of the SDR, because once an SDR, once the CTR has been approved by SARS and you're a non-resident, then technically you're no longer eligible for the CTR. And we've had clients and individuals who are seeking to expatriate amounts of under $1 million, amounts of, say, 800,000 Rand. But because they have done the CTR, they are automatically diverted to the AIT route, which requires tax clearance and so on. So the CTR has now become a very important focus in the post-immigration regime. We're going to go backtrack to a couple of slides in a while and show you what the implications are in terms of your banking relationships with the commercial banks. It was quite clear and when you formally immigrated, because you invariably were placed on the books of the non-resident center of that particular bank. Standard Bank and FNB have large non-resident centers where all their immigrant clients are grouped and are all dealt with in a particular way. But it's less clear, and we're going to cover it shortly, as to what happens when you are immigrating currently. And because the MP336 or the SARB dispensation is no longer available, how does that impact your day-to-day banking? We have a slide on that, which we will get to in a moment. So the AIT, and I should just mention as well, talking about the AIT, if you have ceased to be tax resident and you are now looking to, for example, if you've left many years ago and you want to access your RA, and I think it's important to mention the dispensation for preservation funds, pension, provident, and RAs, is that prior to the 2021 change, the Tax Act said that if you were under the age of 55, that was requirement number one, and requirement number two, if you had emigrated, then you were entitled to cash your RA or your pension or provident fund, which was in preservation form, in full. Obviously, you're subject to certain tax on the lump sum withdrawal, but nonetheless, you were entitled to approach the insurance company and cash in your RA. Now, because the concept of immigration disappeared, that term or requirement in the Income Tax Act became meaningless. So the amendment that followed that is that you could cash in your retirement fund if you were and could show SARS that you were not a tax resident for 3 years. So there was effectively a 3-year lockup period. And if you could show consecutively 3 years that you were not tax resident, then you were entitled to take your RA and remit it abroad. So that's why and many of the insurance companies, and we're dealing with them currently on behalf of clients, the very first step is to say, show me your CTR, your certificate of tax residence. And then they would then in turn apply for a directive. One of the requirements that I omitted to mention in terms of getting a CTR, that application, one of the documents, important documents that you have to upload when that portal opens up, is a letter from the tax authorities in your current country of residence, from the tax authorities confirming that you are indeed tax resident in that country. We're finding that SARS, because it's difficult. We had a client in Hong Kong recently, handled by one of our colleagues in the office, and it was extremely difficult to get a letter of tax confirming tax residence in Hong Kong. Eventually, it was obtained, and the CTR was finalized. So bear that in mind. And almost we tell clients to start with that. So, and we recommend not even commencing the CTR process until you have in your hand that letter confirming tax residence in the jurisdiction where that individual is currently resident.
Also on details of business interest, property, remaining family.
Yes, they do ask for, yeah, as Mike says, any business interests. So I think what they're also wary of, and I think this is a good opportunity to sound a warning, is that you need to genuinely meet the rules, the income tax rules, which also have an impact on the double tax agreements of that point to the fact that you are not tax resident in South Africa. And it's interesting because under the old dispensation, I'm aware of a number of people who might have emigrated, left, and then slipped back into the country and still could maintain that they were non-resident immigrants. I think there's more of a focus now. You can't do that with SARS. Because the rules will apply that you could be given, and SARS tell you in the letter confirming that you have ceased to be tax resident. They say this may change, because if by your physical presence or conduct you under our law could be regarded as tax resident, then SARS may be inclined to revoke your CTR status and regard you as a resident, and of course then subject to worldwide taxes. So I think you need to be serious in making that application. Look, there are people genuinely whose circumstances change. The grass is not always greener on the other side of the fence. And after a period, under immigration, Mike, there was a term which I hated. If you emigrated and returned within 5 years, you were regarded by the Reserve Bank as a failed immigrant, a term which I supported. But nowadays, you've just got to watch that you continue to satisfy the requirements of not being tax resident. The AIT, I think we've spoken a lot about. We've had some questions about. So the final point on this particular slide, and it's a very important document, this SARS External Guide of 24th of April 2023. There is a QR code which beautifully opens up the full 77 pages of this document for you to read at your leisure. And TCS here stands for tax compliance status. Now, one of the features of the move from FIA for the 10 million to the AIT is that, it's provided for in this SARS document, is a TCS PIN, tax compliance status PIN. Now, currently there are two types of TCS PINs that you can get. The one is an automatic and immediately approved one or granted one. It's done electronically, and that is called a TCS PIN good standing. And what SARS does when you apply for that, and you can use your client's e-filing profile to obtain that, is it just checks that there are no tax returns outstanding, there's no money outstanding, and there's no administrative penalties outstanding, because very often you think all taxes are paid, all returns are in, but the return was late and SARS had raised an administrative penalty, and it would still sit as a red flag on the profile. And it's only when that administrative penalty has either been reversed by SARS or paid that you then can successfully obtain a TCS PIN good standing. The other TCS PIN is the one that follows the AIT or the supersized allowance, and that is the one after some time where SARS have had a look at the background and in terms of the funds that you are seeking to take out. And once you've checked all the boxes and SARS are happy, then you're issued with a TCS PIN AIT. And it's a happy day when you get that because you then go straight off to your bank and you provide them with that PIN. And on the basis of that, they would send the 10 million or such other amount abroad. So just to distinguish as to when do you require a TCS PIN good standing, and when is the TCS PIN AIT required? So if you are a non-resident immigrant and you've done the CTR and you are a pensioner or in receipt of an annuity, perhaps a living annuity, then and one of these TCS PIN certificates, good standing, or in fact the AIT, have a validity period of 12 months, then you can use a good standing, TCS PIN good standing, if it's a question of remitting your pension, your regular pension or annuity from a former employer or from a paid out by a retirement annuity or a living annuity. And you don't need a TCS AIT for that, just the good standing. But as I said, the TCS PIN AIT is required in all other instances where money needs to be remitted abroad. So just be sure which TCS PIN you actually require. I see there is a question before
From
we
Luke, yeah.
Move on, and let's just see. Again, Luke, thank you for your questions. You certainly keep us on our toes. And Luke asks, do we have cases of such immigration involving migration in Africa? Well, sure. I mean, Luke, you can be migrating to any country, and you raised an interesting question if you're talking about Africa generally in terms of the continent or sub-Saharan Africa, or within the CMA. So the common monetary area. So the common monetary area typically is Namibia and Lesotho and
Eswatini.
Eswatini. Yeah. So that would, Mike, would that be regarded as a proper migration if you're going to not? So
Botswana, for instance, you would need to go through the whole process because then you become then you're ceasing to be a tax resident.
Yes, Botswana, but because they're outside of the common monetary area, their currency being pula, you would, that would be a proper migration. But I think what Mike is saying, Luke, to answer your question, is that yes, provided it's to any African country other than a CMA country, then it's treated as if it's an immigration offshore. So the fact that it's somewhere else within the continent of Africa doesn't impact that in any way. I think that's we could go back now. Yes, Mike.
I just want to point something out that people might have forgotten, which is quite interesting. In 2003, the then Minister of Finance, Trevor Manuel, introduced an imposition of an exit tax levy on immigration of 10%, which I think made many people angry, including Shuttleworth. Because what Shuttleworth had done is he had sold his interest in this internet invention generated 3.5 billion. The SARB then forced him to repatriate that to SA, which he wasn't happy with, and then he decided to emigrate. So with his immigration, he then had to pay a 10% exit levy. I mean, and hence very critical of exchange controls, etc., etc., etc. He eventually had to pay it. He had no option. Otherwise, he couldn't have externalized his money. Bearing in mind, the SARB, I think at that stage, were fairly lenient. They gave him a 20 million rand travel allowance to travel into space. If one remembers, that was in 2002.
Yeah.
Cheers.
Yes, I remember that well. I sat in for 2 days in the Constitutional Court listening to that case. It was very well argued by both sides, in fact. The judgment was given by former Constitutional Court Judge Dikgang Moseneke, and it makes interesting reading. But effectively, Mr. Shuttleworth lost his case. And I think one understands the reason, because this relates, as Mike said, in the 2010 Pravin Gordon, as one of the many changes, what was abolished was this exit tax payable by non-residents. So it was an exit levy. It wasn't a tax. SARS had nothing to do with this at all. And it was abolished in 2010, and Mr. Shuttleworth's immigration, in order to move his 2.5 billion, was applied for and granted through one of the leading authorized dealers in 2009. In fact, just 1 year before. And that's what made him most displeased, is he felt that if they were possibly aware of this change or whatever, on what basis they take 10%, which I remember was an amount of 250 million. And in fact, he fought this case all the way to the Constitutional Court and said that he didn't really even want the money. If he was successful, he would take the 250 million and create a fund for people to bring matters to the Constitutional Court. But needless to say, and I think that the difficulty that the court had, usually the 11 judges of the Constitutional Court, one was absent. So 10 judges heard the case, was unanimous. Judgment was delivered by former Chief Justice Dikgang Moseneke. And the consequence that the court had to face was that everyone then who had previously emigrated, who paid their 10%, would then be entitled to a refund. And I think that's what concerned the court more. And that's why they found against Mr. Shuttleworth in that case. We're going to go back in the slides to the non-resident banking situation, that one, because this really relates to people who have, so those who emigrated prior to February 2021 were non-resident immigrants and whose banking affairs were already handled by the non-resident centers of one of the major banks. But anyone who emigrates, now CTR, after this date, up to now, it's unclear as to what and how they handle their non-resident banking. So in terms of the latest developments and what we're presenting to you here are essentially 5 steps and consequences of having ceased being non-resident, ceased being tax resident, rather. Now, because this is a communication between you, the taxpayer, and SARS, there's no involvement of the bank. And so point number 1 is that you have a distinct obligation, it would seem, to notify your bank that you have ceased being tax resident. And a number of the banks have different policies and methods of the way they handle these cases. Some of the major cases, and I think Standard Bank is an example here, they would simply, once you notify them and provide them with your SARS letter, they will say, okay, we're going to move your account into the non-resident center. Okay, so you must notify your bank. Interesting and an observation here, and this fell away with the abolition of immigration, is that the concept of a blocked account, years ago it was called blocked rand. It was blocked in a sense that capital was blocked on immigration, but income was freely remittable. So typically what would happen in those days is the bank would open two accounts for an immigrant, a capital account, which was blocked, and a remittable account, which was the income. So if you had money in a fixed deposit or an Eskom stock or whatever, then your interest, or if you had shares, your dividends were paid into the remittable account, and those were free to move without any restriction. But the capital was blocked per se. That there's no such thing as blocking, and even the capital now can be exported. However, you would then need to go and get a TCS PIN AIT. Okay. The third aspect, and this is something that many immigrants were unhappy about, is they lost internet access to their account. And our experience, and we've said this to the senior officials at the banks, is that it's very frustrating dealing with the non-resident center of the banks. They have generic emails. It's not really possible to form a relationship with a particular individual like you would if you were in normal banking, where you'd have a relationship manager or person who looked after you. Even to the point of private banking, where in the days when there were checkbooks, they'd bring you a checkbook, bring you your traveler's checks. It became most frustrating, and immigrants then had their internet access discontinued. So one of the things, and we were responsible in making representations to one of the larger banks, and they agreed then to allow clients, customers of theirs who had completed the CTR process, nonetheless to continue having internet access to their account. Of course, there's the requirement that on a regular basis you are FECAT, which is providing passport or ID, and a utility bill of not more than 3 months old. And different banks have different ways of doing it. Standard Bank, I recall, they need to give you a card, which is your number, which is how you access the internet. So there was always a problem if you were living in London or whatever, they had to get that card to you in a safe means, usually by courier. But once that happened, you had pretty much full internet access. And certainly, if you wish to pay locally and transfer to relatives or whatever, as a non-resident, having done the CTR, you do that through the internet access. And that significantly reduces your dependency on having to speak to an individual at the bank. And I recall not so long ago being difficult if you were living thousands of kilometers away from South Africa and operating your bank. You could only do it by email or fax instruction. And prior to that, the bank required a fax and email indemnity. And there are horror stories for another time and another place of how money was diverted to countries fraudulently, and people had all their funds depleted simply because their details were mimicked on a fax or an email. So I think the fact that customers can now operate their accounts is a great achievement, and reduces a lot of frustration. The next item is the matter of credit cards. So this is still on the concept that an immigrant, or having completed CTR, is restricted in how you can borrow I think banks are not permitted to give an overdraft, for example, to such customers. And similarly, even the provision of credit on a 45-day credit card facility is not permitted. So no credit cards, but anyone having done the CTR is entitled to a debit card. And if they visit South Africa, it is eligible to be presented and used as a charge card or draw money in Rand in South Africa from an ATM. And then the last point, and it's one that I have touched on, is that in relation to pensions and annuities, you only require the TCS PIN good standing, not the ART. So this goes a long way to clarify a lot of uncertainty because the rules changed with effect from 1st of March 2021, as I mentioned, and for some time, and perhaps the banks themselves didn't do a good job, or perhaps were just simply unaware that their clients have completed the CTR process. So what we have here is how banking relationships should be conducted. The next slide really, and again, confirmation of something that George touched on at the outset, the phasing out of exchange control, this gradual phasing out, given that we didn't go the Maggie Thatcher route of the Big Bang, was to even call a rose by another name. So we have exchange control, but the department within the Reserve Bank is not called the Exchange Control Department as I knew it years ago, and it's now called FinServ, or the Financial Surveillance Department. So again, and I think that from time to time, my discussions with the authorities, those within the Exchange Control Department would be deployed and would be more focused with anti-money laundering and so on. So it was thought that financial surveillance was a more appropriate term as compared to exchange control, because exchange control is on the way out. The next point really, and there's been quite a bit of news on this more recently, where the Reserve Bank acted, could have been last week, I think, and this is to do with the Steinhoff debacle, where an amount, I think it was in the order of 6 billion rand possibly, was seized under the very wide and harsh powers that the Reserve Bank have, where they can block funds, block accounts, if they believe that there have been contraventions. They can seize assets, as they did indeed in the Steinhoff matter, and they can also issue fines. So this would be a good point to tell you a bit about how one can go about a contravention. So if you're a practitioner and you're approached by an individual who has perhaps contravened exchange control in some way or another, then how do you go about a regularization process? So historically, and if we go back 21 years, in 2003, there was a very generous and wide tax and exchange control amnesty. And and I believe, and I recall that there were 45,000 applications, probably almost all of them successful, for amnesty, because they had contravened exchange control in some or other way. And I think the most common, and in our office we probably handled, I think about 500 of these cases, is they were really the depositing of travelers' checks or abuse of the travel allowance, the 750 travel allowance as it then was, because people would apply to go on holiday, would be provided with the travelers' checks, and then instead of, because the rule was at all times that any unexpended travelers' checks or travel allowance upon your return, you to present that and resell that foreign currency to your bank. For whatever reason, best known to the individuals who perpetrated these deeds, they just dropped off the travel allowances, either with a relative overseas or opened a bank account. And that was, of course, in contravention. So I would think a good 70%, in my experience, of amnesty applications in 2003 were people who had misused the travel allowance at the time of 750. And the Reserve Bank was very condoning and granted amnesty in each instance, with a 10% penalty, which was a gift compared to later years. And then there's the spirit, and other countries around the world have also done this in relation to tax. The government repeated the goodwill through a process of 2 VDPs, voluntary disclosure programs, invariably involving SARS as well. So they dealt with contraventions of exchange control and what was called tax defaults. And on the SARS side, I must say that it was such a successful venture that the VDP, the concept of VDP from a tax point of view, was institutionalized and embodied in the Tax Administration Act and is now a permanent feature of our tax law. Sadly, though, exchange control have not done as SARS has done. So, and it's unclear at the moment. So we do, from time to time, are approached by clients seeking our assistance to regularize contraventions of exchange control. And invariably, that could attract a penalty of anything between 20% and 40% of the amount of the contravention at the current value of that foreign asset. So it doesn't refer back to the amount that you removed, but the current value. So, I mean, there were many who used the subsequent VDPs in 2010, 2011, and then again in 2016. I think the deadline was the 31st of August, 2016, and many people came forward. And the Reserve Bank have been silent on policy. There is one aspect where they are clear from a regularization point of view, is that, and this is on the biblical principle of not punishing the sons for the sins of the fathers, quote unquote. And that is, if there is the matter of an inheritance, which is a contravention, and you or your client is an heir of the deceased who perpetrated that contravention, then to avoid any penalty, you can simply repatriate the entire amount back to South Africa and avoid penalties totally. And of course, you wouldn't have any problem in doing that, because you could then be quite entitled to go to SARS and apply for an AIT, and you'd explain that you received this money and so on. SARS might say, was that person an individual? Was his state duty paid? But it depends. It may have been many, many years ago. There may not be any details of that. So certainly the Reserve Bank are open via the authorized dealer to any applications for regularization, although what is lacking at the moment is a clear policy of when would it be 20%, when would it be 40%, and those are dealt with on a case-by-case basis. But the Reserve Bank, in our experience, are quite sympathetic on that. Yes.
Sorry, just to add to that, agreed. Regularization policy is a gray area, and they need to jack that up a bit. 0 to 40 or 20 to 40 is on voluntary disclosure. If it's not voluntary and you get caught out, then it's 100%. in days gone past, we used to submit what we called anonymous applications detailing the exact circumstances of the contravention. And in that way, we would get guidance from the compliance department, it was called the investigation. And then we could decide whether, it was anonymous, no names mentioned. They don't allow that anymore, so now it has to go through the bank, and they would then do the application on behalf of the client. And you never know what the outcome is going to be, unless it's a clear-cut inheritance, as mentioned earlier by Anthony.
Mike, sticking with you, and the next slide, and it was touched on earlier, is this announcement again from the 2020 budget speech. And I think not many people know what is meant by the capital flow management framework, but you did mention turning it from a negative to positive. Is there any additional comments? The third point, the concept of immigration, we've discussed at length, but in the other two, in terms of the CMF, MF, anything that's, because this seems to be very much work in progress.
Absolutely.
On the part of the Reserve Bank.
I think just to latch onto that, we can mention, for instance, outward FDIs have evolved from, I don't know, what was it, 50 million in days gone past, up to 1 billion not so long ago, and now up to 5 billion. So anything under 5 billion, and if the authorized dealer is happy with the content of the request for the outward, they can agree to it without referring it to the SARB. But what happens now is the banks are too scared to make a wrong move, because just so they get investigated and get fined by the central bank. So everything then gets submitted to the Reserve Bank, which defeats the whole objective of this red tape and getting rid of all the hurdles. Let the authorized dealers handle 90% of the applications, and in that way they can satisfy their clients. Unfortunately, that's not happening at the moment.
What Mike is referring, just to debunk some of the jargon. So a foreign FDI is a foreign direct investment. Now, the Reserve Bank for some time, and at a point they were approved by the authorized dealers, is they allow a South African resident company to invest in a similar business abroad. And again, we've handled a number of these types of applications, all routed through the authorized dealer, of course. And what is required is a motivation, and part of that motivation is really to demonstrate that South Africa will benefit. We find the best, particularly, so this would be a South African manufacturing operation, for example, acquires an interest in a foreign factory producing the same sort of goods. And the sort of information that the Reserve Bank like to hear from a motivational point of view is that South African workforce would be sent abroad to the foreign factories, be trained, and bring those skills back on shore for use within our economy. And the investment requirements are in fact quite minimal, almost as low as a 10% stake.
Yes.
Is all that's required, and that doesn't even need to be an equity stake. You could almost even have a loan as well to the foreign corporation. So that's an area where we find a lot of people who perhaps frustrated in not being able to go through the laborious AIT process, and I mentioned it can take 3 months. We would suggest that you consider whether a foreign FDI, in other words, within your existing business, there's an opportunity to invest or even start an equivalent business. In other words, you incorporate a company in the US, the UK, or anywhere in Europe for that matter. And you'll be amazed at how generous the allowances that you can get to set up that business, working capital, salaries, which could include a South African resident relocating to champion that business offshore. So, Mike, thank you for mentioning the foreign FDI, because that is a good opportunity and one that is almost encouraged by the Reserve Bank. And the authorized dealers have a checklist. And as I say, as long as you show benefits, you must give them 3 years of pro forma balance sheets of that new entity. And they'd like to understand the cash flows and the profits that are going to be generated. And again, that doesn't need to be automatically, the dividends don't need to be repatriated back to South Africa. They can remain offshore, reinvested, or retained in cash. There's just a requirement if you look at the fine print when you get the approval in the first place, if you ever dispose of that investment, then of course you need to tell the Reserve Bank, and they may well say you need to unwind and bring the funds back to South Africa. But definitely worth considering the foreign FTI.
I don't know if you want to perhaps let me touch on other red tape that was reduced.
Yes, it was on that.
Is the loop structure.
Please do.
You know,
well, yes. Okay.
I'm not sure, loop structure, I think, is a fairly common term, which everybody should be aware of.
Well, let's put up the slide.
Okay, so before we go on to that, one of the points that George has made is a stronger cooperation between PEAK, SARB and SARS, and that's quite important. And there's a sharing of information there. So that is one of the outcomes of the capital flow management framework. Okay, we can go on to the loops, I think.
So what is a loop structure? And we've drawn in its simplest terms because people have looked, and if you go through the CMAD documents that we referred you to, and if you Google or use any other search engine to put in loop structure, you're not going to find a document, because people say to us, well, is there Reserve Bank policy? Is it written anywhere about loop structures? And it's not. And perhaps I'll give you the reason why there was this initial aversion to loop structures by the Reserve Bank, is that it was a way in which South African residents could externalize money outside of the SDA or the AIT. And this diagram illustrates exactly how they would achieve that. So you have a couple of individuals in South Africa use their AIT to externalize money and invest in a foreign entity, which is, in this example, the triangle indicates a trust, which holds 50% of the shares in a South African company, where they onshore hold the other 50%. Now, how can this be abused or used to externalize funds? Well, quite simply, it's a loop structure, because the South African company can declare a dividend of that is attributable to 50% of the shares offshore, which can remain in the foreign trust. And that would put these individuals at a distinct advantage compared to anyone who had to go through the motions of the AIT, which you would know by now is a very laborious and timely and costly exercise. So, Mike, loop structures, you mentioned red tape. There's been some developments, and you're close to the Reserve Bank on this. Perhaps you can just share with us their current thinking.
Thanks, and it did evolve, and they sort of liberalized along the way, and then it was a 40% okay, etc., etc. And then it got to the stage that they issued a circular 1st of January 2021, where there was a big development by saying, hang on a second, loop structures are okay. All authorized dealer has to do is scrutinize the thing, and then at some stage refer the details back to the Reserve Bank, which was great. But then investors started abusing it by bringing in nominal capital of $100 and then borrowing locally, and doing all sorts of weird and wonderful things. And then that was put a stop to. We're still actually waiting for the follow-up circular to state what exactly they need and what they want. But me working through the authorized dealers, they are submitting applications. So it's not a matter of approving it by the bank and then referring the detail to SARB. They now have to submit an application as they did in the past. which are being adjudicated, provided there's forex that's introduced and it's at fair market value. I think those are the basic tenets, you know, of this investment. But it's not very clear, you know, there's no sort of definite guidelines. You know, this is what we want, this is what we need. So the banks submit what they can. And all lead requests are submitted, which is not the intention. The intention was to take that burden away from the Reserve Bank and then place the responsibility on authorized dealers. They abdicate a lot of that responsibility due to the fear factor. I mean, you know.
Right. We're probably nearing the end of the presentation, and we've noticed that the questions have dried up. That's a good thing, because we believe that the thoroughness of the presentation has eliminated the need for any questions. But we invite you, even at this late stage, if anything that you may be pondering about, you're welcome to have this perhaps last opportunity. We will shortly also be putting up a slide with our contact details. And once the webinar is over, you can in your own time approach us as well if you have any questions, which we'll gladly try and assist you to the best of our ability. This is the technology that is relatively new, the QR codes. And here are some interesting links. So the one on the extreme right, the Shuttleworth case. So if you want to read Dikang Mosneki's judgment on the Shuttleworth case, that link takes you directly to the full text of the judgment. The middle QR code is the publications of the FinServe, Financial Surveillance Department, and then, of course, the Reserve Bank itself. So I think that there are no further questions.
I just want to,
Mike, yeah, in closing, and George.
You mentioned the article regarding Steinhoff. That was actually published yesterday. And the heading was Reserve Bank Clampdown. And I think, you know, this goes back to the very first slide where fear factor was mentioned. But why this is the case is because of the FATF, the Financial Action Task Force, and the grey listing. And I think that has a detrimental effect on cross-border flow. So everybody's a little bit jittery about the Steinhoff situation. How did it happen? To an extent, government and so on could be blamed, you know, and the Reserve Bank is crucial to getting us off that grey listing. So banks are a bit jittery. Everybody's a bit reluctant just to nilly-willy agree to cross-border transfers. You know, and I think it's just the climate that we're living in at the moment. And we'll only be able to adhere to all those tip points next year sometime, if at all. I mean, we've only delivered on 4 or 5. We still need to deliver on 8. So that needs to be sort of looked at or taken into context. Thank you.
Right, thank you, Mike. And just as we pull up the final slide, that 6.2 million or whatever the Reserve Bank seized from Steinhoff,
yeah.
And my understanding is that goes not necessarily to into SARS's coffers,
National Finance
but it's
Fund,
yes, it goes to the Corporation for Public Deposits,
yeah.
which is the Reserve Bank's own, dare I call it, slush fund or bank account.
And they just take some of that away.
Yeah, I wonder what would happen and whether any of that goes to alleviate the plight of the national budget. But that is just by the by. So we've got to the stage with some time to spare, but we want to thank you for your participation. We're very pleased that we've maintained our audience and participation and have not had a significant drop-off rate. So thank you for listening to us. Your questions have been great, and here are our details. If you need to reach out to any one of us, feel free to do so. Danny, and without any further questions, and thank you to thank our team. Firstly, Mike, to you for your insight and your vast experience with exchange control, and in the 10 years, and congratulations on the 10 years that you've been in our office. Really proud to have you on board.
Thank you.
To George and Katya Maltese, who put together all these slides, and George and Katya spent many long hours putting these slides together, and we salute you both and thank you for this wonderful effort, and really added to what I would say the quality of this presentation. So thank you to you both. And then to you, Danny, and to Stan, as part of CPT, and we're proud of our association from time to time. We've done some of these for you. Thank you for inviting us to participate.
And from my side, thanks to Anthony for facilitating. He's brilliant at that. Thanks.
Yes, thank you very much. I think everybody earned their points today. 10 out of 10 for you, and I'm sure that a lot of takeaways from today. As you said, Anthony, if they need to contact you, they're welcome, and you do have the notes and the slides, so you can refer back to them. Are there still more questions?
Yeah,
I thought everybody had
Danny?
left.
A lot of people are just saying thank you. I just see on my side.
No
But,
question,
yeah,
it's
it was,
Thank you.
a comment.
it was a very fair
That's
comment.
very
It was-
good.
yeah, it was-
People appreciative of your work. And once again,
beautiful.
thank you. Thanks to everybody who joined today and, as I said, earned their points, and your certificates are on the way. So you should have them this afternoon. And we see you in the next month when there's another, and we've still got some webinars planned for the rest of the year. So thank you, and a big thank you to Anthony, George, and Mark for an interesting afternoon. Thanks very much. The rest of you can go home, do whatever you want. We've finished an hour
Listen,
early, so
at home.
we're still going to give
Cool.
give everybody the points for the 3 hours.
Well,
Don't
it's
worry.
actually only actually 10 minutes earlier. Normally we started at 1, remember? Not
Oh,
2.
yes, sorry.
So it's a bit of confusion. Sometimes we started 2, so we thought
There's three kinds of people in the world: those that can count and those that can't.
Beautiful.
yeah. Our
Thank you
next
very much,
presentation is
and
in 3 weeks' time.
yes, and
With
see you
Cheryl.
everybody next time. Thank you.
Cheers.
Cheers, everyone. It was
Thanks
really
for
nice.
everyone.
Thank you.
Bye-bye.
Bye.
Bye. Okay.
Well, Brian Kettle's our auditor. He's the last guy. Thanks, Anthony.
I saw that.
Auditor.
Anthony